G'day, folks. Welcome back to another edition of the Rough Consensus podcast. Today, I had a great conversation with Joe Carlasare, and we covered so many topics from the regulatory and legal side of the equation, which is really his specialization, all the way through to how he thinks about the macro environment. And really, we are students of markets, trying to take price signals, what's going on with interest rates, trying to understand whether it's a recession or not, how to really decipher all of the data, all of the components. And we close out with a really thoughtful discussion on what makes a store of value. How does Bitcoin, how does gold, and how do stock market indices all play into this role of being some kind of store of value in a world of debasement? So this was a fantastic conversation. We had lots of great back and forth, and I think you're really going to enjoy it. And just a quick reminder before we get started, do head over to checkonchain.com. You'll get access to our full charting website, which is free and has pretty much any Bitcoin chart you could possibly want, from on-chain data through to derivatives and ETF metrics. And we also have a live newsletter, which gives you 2 market updates per week. We focus on what's going on in the market, what are the different tools and metrics I'm using to understand what's going on. And we also have a masterclass section that helps people really understand the nuts and bolts of how these metrics work and how to use them in your own analysis. So head over to checkonchain.com, and I hope you enjoy the episode. Cheers.
Let's chop it up. Let's go.
Let's go. Yeah, chop it up. I think it's the right terminology. But g'day, folks. Welcome to the next edition of the Rough Consensus podcast. And today I've got Joe Carlasare, or as my friend Dale Warburton said, the Legal Eagle, which I thought was a fantastic name. How you doing, mate? Good to have you on.
Oh, it's a pleasure. I'm so glad we get to chat and talk, because this is exciting, right? I was just looking at NVIDIA, the action after hours here, and when we're recording it, and man, what a time to be a student of markets.
Absolutely. And I've said this in the past. In my formative years in 2019, there was this group of people, like the Macro Voices crew, and they were all like the contrarians, and they seemed to have the same opinion. Now everybody's got a different opinion, which is fantastic. And I can't help but feel that because whatever this new regime is, higher rates, inflation, just this switch that we've seen since COVID, people don't actually know what is going on. And I love this because it forces you to really dive into data and also question the data as well, because the data doesn't necessarily tell. The headline number is obfuscated, different. The denominator's been cooked. There's all sorts of things that mean that you have to really think that extra layer as to what you're really looking for and why.
Well, the data, right? The inputs. And then one thing I think we should get into is, from the inputs, we derive these indicators, right? Like the idea of the yield curve, the idea of unemployment claims, the SOM rule that I've had back and forths about, and I went back to the original source material for that, and we can chat about that. But if the data is bad, garbage in, garbage out with the indicators, even if the indicators are built well, and then there's a question: are the indicators themselves, are they flawed, and are they the wrong indicators for the wrong time? But where do you want to start? What's a good segue from there?
Absolutely. So, I mean, I really want to get into the macro stuff, but actually I think, because this is probably the most left of all of that, I actually want to start with your just broad view of the regulatory and legal shifts that have happened since FTX, because this cycle has been really interesting, if you even want to call it a cycle, right? I think we're going to get into the total cycle as well, because I'm definitely a fan of that idea. But how has the world in Bitcoin and just the world around it evolved since FTX from that legal and regulatory framework?
It's an awesome question, and I'm glad you asked me about it, because that's really my wheelhouse. As much as I like to be a student of markets and have for decades followed markets extremely closely, back to before I was even in high school, I was trading and trying to navigate the markets. But my day job, right, is obviously in the legal space, and it's focused on the broader Bitcoin and cryptocurrency. And I advise clients on a regular basis on regulatory issues, on litigation. And what I always start with, if you're trying to understand where we're at now, is you have to go back, right, pre-FTX collapse, because pre-FTX collapse, SBF and his allies on the Hill, they were really the voice of the industry. Those were the folks that were actually trying to push forward serious pieces of legislation. They were spending the lobbying dollars. They were trying to build the connections. And there were politicians who were actually closely aligned with trying to get something through. Obviously, SBF's family was extremely well connected. They had a lot of political capital, social capital that they had built up for many years, and that was being parlayed into I think it's one of the reasons why FTX had its success, why it blew up so blew up in a positive sense so quickly, right? It actually was a huge commercial overnight success where, he's on the cover of Forbes as one of the youngest billionaires, and the next Warren Buffett, I think, was one of the captions, how they were presenting him. So what I think transpired is this. He had built up a ton of political capital. He had built up a lot of allies. And then when it blew up and was exposed through, that leak of the balance sheet by, someone, all those sort of attacks that went on, and then it turned out to be fraud, like actual fraud that was being conducted. Now, he's been found guilty of it. We can say that it's not just allegations. This was something, that was documented. I think even the allies and political supporters that he had built up, they, turned a blind eye. They said, we can't touch this. This is radioactive. We don't want to jeopardize our career. All the celebrities from Tom Brady on down that had been behind him and had supported him, they said, nope, this is done. We got to distance ourselves. So what I think at that point, the message that came, at least from the administration, was that we need a pound of flesh. SBF is not going to be enough. And I think the gloves were taken off of many regulators to file numerous pieces of litigation. If you look back at the chronology, and I said this at the time, I said, we're hearing numerous pieces of meaningful litigation that's going to come from the SEC and the CFTC. And in the months that followed, there were suits against most major U.S. exchanges, up to and including Coinbase, the big gorilla, right? And right now, despite what all the politicking, despite the election year, positioning, we have the SEC it's in court arguing that Coinbase, the biggest exchange, the one that holds all the Bitcoin for all the ETFs, that they are actually not able to exist as a digital exchange, right? That as a cryptocurrency exchange, that they are not regulated, that they don't have the proper licensure to be broker dealers, clearinghouse, and engaging in exchange related activity. So from my perspective, I think you had, let's get something done through Congress. That was the idea of really 2021-ish into 2022 to the 2023 position, which was, we can't get anything through Congress. Let's let the regulators go after it. Let's let the enforcement actions take place. And the SEC has been on a nonstop campaign from there. So where do we go now? Now, interestingly enough, because of the political climate, you got the administration taking the position that they're filing all these cases, and they're saying everything under the sun is a security other than Bitcoin. And at the same time, the most interesting thing for me is that you've got the political candidates jockeying, at least in some respects, to try to be more open to crypto and sensible regulation. So it's kind of the pendulum has swung from let's get legislation passed to let's go full on enforcement to let's try to get something done that's sensible, it's a fascinating progression. And it just shows you how even our government, who people look at as a monolith, there's huge divisions within the government itself, even among party members.
That's fascinating. So Coinbase still has this litigation going on. This is still in play.
Yes, Coinbase has it on.
Wow.
Other major exchanges have it on. Most notably, there were motions to dismiss. And in my world, where you're a litigator, the key thing is you really try to do your best to knock out claims on a motion to dismiss. So for your viewers that aren't familiar, when a case gets filed, right, anybody can file any case. I could walk down and say, James, you helped an alien steal my car. It doesn't have to really have any basis. You can go just file the document. The key thing then at that point is the complaint plausible? That's the standard in federal court. Is there a plausible set of allegations upon which relief can be granted? So what we do as litigators is we usually try to move to dismiss a complaint. And the reason, James, you want to move to dismiss a complaint is because the most expensive part of litigation is always discovery. That's where you're taking witness statements. That's where you're getting interrogatories. That's where you're having to produce documents. And what a lot of defendants do, particularly clients I represent, they say, well, we don't want to have to spend all that money because there's no merit to this claim. There's no, it's not a viable cause of action. So we're going to move to dismiss it. So in the Coinbase suit and in other suits, the Kraken suit, we just got an order in the last week here. The SEC has won, and meaning they have defeated motions to dismiss brought by the various exchanges saying, you can't bring these claims. These are not plausible claims. Well, in Coinbase, other than the claims against their wallet, everything else, the judge basically ruled, no, this is going to move forward to discovery, and we're going to let a full record be made. We're going to let all the discovery the parties need within reason be completed. And then you're going to move to what's called summary judgment, which is really the key part of the process where the judge decides based on the record if there is something where there's a question of fact where there needs to be a trial. Most of these cases are resolved on summary judgment, either positively or negatively in the SEC's favor. But the key thing is, I think when these cases were originally filed, a lot of crypto commentators said, they'll get all dismissed. They'll all be dismissed on a motion. They're not viable. Every one of them has been allowed to go forward. Even in the Ripple case, right? The Ripple case, they brought a motion to dismiss, and the judge said, no, I'm not going to dismiss this. I'm going to let them have their discovery. Then after a motion for summary judgment at the end, that's when the judge ruled in favor on most of the claims in favor of Ripple Labs. But this is a long haul. And the interesting thing for me will be if you get a new president, or you will get a new president, right? We know now you'll get either Kamala or you'll get Trump. If that new president will continue with the SEC in these ongoing pieces of litigation, or alternatively, they could resolve these cases, right? They could enter into some sort of settlement arrangement, and maybe there's a fine involved or something like that. I think that is more probable than folks think, that there is some sort of brokered resolution, because by all accounts, it seems like the administration currently has tried to move closer and shift some of their positioning towards the industry. And I think for certain, I know for certain that the Trump administration, if it was elected again, they have a very different view of the space.
So out of interest, are there any kind of big overhang risks that remain? So one that obviously I think stands out and is something that we should never ignore is that Coinbase has an absolutely gargantuan pool of coins of everything, right? But particularly Bitcoin.
Mm-hmm.
Are there any risks? I mean, I would assume that there's probably a lower risk over time. It looks like with the ETFs, with Wall Street getting behind these things, there's more money, there's more scale now. Two presidential candidates speaking at the Bitcoin conference. We're getting to that point now where the pendulum probably has swung. Are there any
Yes.
really big curveballs? Because there was a point where Binance was going through all that discovery, and that was like that's another behemoth that if that kind of went south. But are there any like big curveballs that you can see, or you think generally speaking, it's a path to improvement? Is there anything kind of stands out in your mind?
Well, the biggest curveball on a going forward basis continues to be, I think, in the crypto space generally, as opposed to the Bitcoin space. We now have what we call district court level decisions that are really a split, right? A split in terms of their rationale. We have some district courts coming down, and most notably the SEC versus Ripple Labs decision by Judge Torres, saying secondary market sales, those are not investment contracts. Those aren't securities. She explicitly sort of carves this out in her opinion and the rationale behind it. Whereas now you have some other courts, some other federal courts that are co-equal district level decisions where they're saying, no, we're not going to draw that broad of a brush, paint with that broad of a brush. We are going to say that, no, there can be secondary market sales that qualify as securities. Because as you know, the altcoin market is really, I think, intertwined, and Bitcoin serves mostly as the collateral of choice for the altcoin market. Impacts on the altcoin market, I think, affect Bitcoin. I'm not one of these Bitcoiners who thinks that this altcoin space has nothing to do with Bitcoin. I think that is true in concept. I think they're very dissimilar in a lot of ways. But I think that with respect to liquidity, I always believe in sort of this revolving door between the altcoin market and Bitcoin. And I think that depending on what your favorite dominance gauge is, you're seeing some of that. You're seeing a lot of altcoins continue to wither and struggle against Bitcoin, most notably Ethereum. I mean, Ethereum, man,
it's been a bit of a
really
reckoning,
struggling,
particularly for that camp.
Yeah. So I think there's uncertainty there. And you got to, I really do believe that in bull markets, in a real rip-roaring bull market, I think the altcoins play a significant liquidity role in pulling in new capital for Bitcoin. We can get into why that is, but I do think there's some of that out there. So if you have a depressed altcoin market on a structural basis, I think that changes the bullish outlook for the Bitcoin market in the near term. Now, to just go back for a second, if you are continuing to attack these exchanges, theoretically, and this is an outlier risk, okay, this is a tail event that I don't want people to be overly nervous about. But if there was some sort of, full court press win by the SEC in the Coinbase suit, technically, Coinbase can have an injunction imposed against them where they're not allowed to engage in any exchange-related activities, including Bitcoin. That could theoretically be a result of the current litigation. Not saying that's probable. If you just to put it in context properly, I would estimate the chances of something like that happening at lower than 10%, right? But that's fascinating because that's where the majority of the ETFs hold all their Bitcoin. And if that entity is not allowed to exchange in any related any coins and sell coins, buy coins, that really has a serious structural issue that the ETFs are going to have to figure out how we're going to deal with that. I think Fidelity and maybe one other are the only ones that don't use Coinbase as their prime, custody provider for the ETFs. So that's an interesting thing from a structural standpoint. What does Coinbase do in that environment if it really faces a significant defeat? But I don't expect that. Actually, my base case at this point is some sort of brokered resolution with Coinbase to move forward. And what I really am optimistic about is the potential in the next administration, depending on who wins, right? Getting an omnibus piece of crypto legislation passed. I really hope that comes to fruition because I think it would be such a bullish catalyst for the space as a whole.
Yeah, so I don't want to go too deep into the crypto stuff because generally my Bitcoin focus. However, I love your spicy takes, and I've got my own. Like, I still like the crypto puzzle, right? I like looking at it and trying to understand these dynamics. So let me test my thesis on why we're seeing, particularly for Ethereum, but generally speaking, the crypto space it's really struggled. It's almost a little bit like the Mag 7, right? We're really seeing this narrowing down when there's a handful of assets like Bitcoin, Solana, and then the most ridiculous meme coins you've ever seen. They're the only ones that have really performed. And my thesis is the crypto natives, we haven't seen any serious new money come into this space yet. I think this cycle has been mostly the existing HODLer base and some institutions into BTC, right, via the ETFs. That's really where I think the majority of the new money is coming from. So with that as context, I think in 2021, we had the everything bubble where it was this beautiful capital waterfall, Bitcoin, Ethereum, L1s, DeFi, all the way down to monkey JPEGs, right? There was this like beautiful waterfall of just getting worse and worse down the risk curve. Crypto natives learnt that if I want to make the most money, I buy the most stupid coin, right? So in a way, they kind of learned the rule book of Monopoly and went straight to the end. They bought Bitcoin because of the ETFs and they went straight to Pepe token. And it was this kind of like gap in the middle where no one touched anything. And then you've also got, I think for Ethereum specifically, it took the path of trying to beat Bitcoin, which is, I think, is a lost war. And you had this great tweet where it goes, "Nobody's blowing up. ETH just sucks." And I thought that was, I mean, that's ultimately my like core thing is if Ethereum launched today, would anybody use it? And I just don't think that they would, right? It's got so many of these structural issues. So that's like my general framework. I think that the joke has been told. Everybody knows the punchline, and they've just gone straight to the punchline, and it's just not funny anymore. And that's like my core thesis for now. Why we haven't seen this alt season.
It's a great thesis, but I think let's unpack it. Okay, let's go a little deeper. Okay, because this is you bring up a great analogy, and I think it is spot on with the Mag 7. Ask yourself why in this environment, this kind of goes in the macro space, which I'm sure we'll get to, but why in this environment are the strong getting stronger? Why are we in an environment where the mega caps are sucking in significant amounts of liquidity? And unlike what investors have become accustomed to, where you just have this, okay, we're in a bull market, everything rises, the most speculative, most high beta stuff is going to run the fastest. You haven't really seen that. I mean, look at ARK, okay? The ARK Innovation ETF, ARKK. It is trading, I believe, at like the June or May of 2022 levels, right? Meaning it's just been basically trending sideways, never gone back up. You've seen, other high beta names that have never reclaimed or come remotely close to what you saw in the quote unquote everything bubble. And let's look why structurally that is. Structurally, I think there is an argument that while liquidity is plentiful, I do think that liquidity conditions are actually improving. I think you can cite to some evidence of that, whether it's through the fiscal dominance narrative or some of the other aspects, consumers being relatively protected from higher interest rates. I do think that liquidity conditions are generally decent at this juncture. But that is not to say that the liquidity is flowing in all directions as it was during the QE era, during the ZIRP policy era. You have targeted areas where those with significant pools of capital are placing bets on companies and entities and assets, in the case of Bitcoin, right, that they have much higher degrees of confidence in. And there's not just this shotgun approach to liquidity where it's going everywhere and lifting all boats. I think that is primarily a product of this sort of weird dynamic we have where we have high rates and at the same time high fiscal spending, because the high fiscal spending, right, these huge deficits are driven by the higher rates. And what does that do? That pushes capital, that pushes income into those with assets, those who have significant pools of capital. This is why Google, I think, made, I can't remember, it was like $1 billion or something from interest, just from interest from some of the accounts they're holding. Right. So the
like
stronger,
Tether. I mean, it's one of the most profitable businesses on the planet.
What's that?
Tether. They're like the most profitable business on the planet. They just sit on treasuries and they just print money.
Exactly. So while if you look at liquidity as a whole, right, it's in decent shape. There are certain industries and there's certain entities and certain individuals, right, in society who are starved of liquidity. People that have had all their wage gains getting eaten up by inflation, right? So you're seeing this sort of people call it a K-shaped recovery of these types of things. But the important takeaway is that you can't just look overall. You have to look like sort of what segment is benefiting from the current dynamic and what is not. And I think you can go asset by asset and see, like an asset like gold, it makes tremendous sense to me why that is rising in this environment with huge fiscal deficits, right? Now, IWM and some of the other, interest rate sensitive companies, they're struggling more relative to the Qs, who I think, the bulk of that indice, it doesn't really care about high rates. It's not hurting them in any appreciable way. So to me, I think that is found in the crypto market, right? You see the higher beta plays, they get these little pops, right? Even that meme season we had earlier this year where, I don't know, so those who shall not be named were trying to get me to buy like Pepe coin and these little things, like they basically popped, and then you got mostly just down only for several months here. That is not what I think we saw in prior quote unquote bull markets, to the extent we had prior cycles, right? Whether that was a thing, which is debatable. I think you had liquidity conditions very different in past periods than they are now, which is probably why we're seeing different results in the crypto and Bitcoin space.
I 100% agree. And I think the other one is that higher rates, harder money forces people to make better decisions,
yes,
right? Which is ultimately, if you actually think about what we're looking at with higher rates, it is the Bitcoiner thesis of what happens at the end of this whole thing, which is that, the money is more sound. And ultimately, the biggest risk to Bitcoin is not that we're anywhere close to this, but like fiscally responsible governments, the dollar that's not getting debased. These are actually the biggest risks to Bitcoin, is that they start being sensible with the money. And in a way, because you've got higher rates, capital allocators have to choose where they put it. And even you look at things like Warren Buffett, right? He's got $250 billion in cash equivalents. He's there to re-liquefy. He can't find stuff to put his money into, otherwise he'd be invested. He doesn't think it's the right time. He's basically waiting to re-liquefy the system when the time is right and buy good companies at the right price. So it's this really interesting dynamic where, like, the sound money principles that we all talk about with Bitcoin, we're getting a very small snapshot of this. And I actually also like when you see countries that dollarize, right? If Turkey and people naturally goes from the lira to Tether, for example, that's like a quantum leap of soundness. It's kind of the same magnitude as us, in the Western world going from the dollar or, the euro to Bitcoin. It's that, or gold. It's that same like leap of difference in soundness. So I think that's a huge component of it. And also I like the idea of the liquidity profile. It's like the same money that's sloshing around, with the exception of the interest payments from all of these higher rates going to bondholders. Where do bondholders put it? Probably not into Pepe token, right? You're not going to see that sustained flow of capital.
But I do think some of them put it, they rotate into, okay, here's a good time to buy Microsoft. And I think you've seen some of that. I mean, I think they're saying these are, they used to call it blue chip stocks, right? Like they don't want to gamble. They want to put in blue chip stocks that are really solid. They have core fundamentals that even if you end up in a recession, Microsoft may take a hit, right? But it's not going to sell off 80%. I don't think it will, at least unless it's some serious financial crisis. So I think that is playing a big role, and that's partially why I think you've seen, by the way, consumer demand stay high, right? The income that people are getting from these huge amounts of deficit spending, I think is driving a lot of the service inflation you're seeing. It's making it stickier. I think it is affecting the real estate market. Some of the biggest swaths of purchases I was looking at over the last several months have been all cash purchases. Okay, that's cash assets. Where is that cash coming from? That's coming from those who have built huge war chests of cash, and those cash are being subsidized by the U.S. government.
G'day, folks. I just want to take a very quick moment to remind you of our partnership with the Bitcoin Advisor, who are market leaders in the world of multi-sig vaults, collaborative security, and inheritance planning. As I grow older, I found myself thinking more and more about that long-term question of what would happen if I didn't come home one day, but also the security and peace of mind of how do I secure my seed phrase and my coins for life. Now, what I decided to do is run my loved ones through a test, and without any of my guidance, spend a coin from my cold wallet. And what I quickly found out is there was a whole laundry list of ways that my coins could have become lost, locked, or sent to the wrong address, and I just didn't have the confidence they'd be able to access my proof of work if I wasn't there to help them. So the Bitcoin Advisor has a team of people around the world. Many of them are my friends, and you've seen them on Twitter, podcasts, and in the conference circuit. They are there to help onboard people and remove those single points of failure, many of which you may not have thought about in your long-term custody setup. So if you are interested, head over to our landing page in the link below, book a free, no-hassle consultation, and secure your coins for life. Thanks, and let's get back to the episode. So I know that you watched the the conversation I had with TXMC, and we spent a lot of time talking about interest rates and the role of the Fed, and this inflation deflation debate. What is your general thought on the role of interest rates? Because from my take, I definitely agree with the fiscal dominance, and it just makes sense from a common sense perspective that you've got all this extra money coming in, you've got all these houses, particularly in the US, locked in at lower rates. If they drop it 50 bips, is it really going to be a marginal impact? It will definitely help. I mean, over here in Australia, you're going to have, give people 0.1% off and they'll be happy because they're stressed, right? So outside the US, there's going to be a huge amount of stress. That's actually relieved. However, in the US, I don't think that's going to happen. That's really the centerpiece of capital. So where's your thoughts on because I think rate cuts are probably coming. This seems to be where the bond market and the Fed's pointing towards it. How much of an impact is it going to have? Because I can't help but feel the market's probably going to price this in, and then it may not, they may not get the kind of impact that they're expecting in what's priced in. I don't know whether this thing goes higher or lower. My gut feel is if we trade higher into the interest rate cuts, we probably go lower after it. If we trade lower into it, we probably go higher after it.
Okay, so what I want to make sure we stay focused on is the economy versus financial markets, and I think it is a crucial distinction. And what I found frustrating, and I have been guilty of this, speaking on many occasions, is I think we tend, because we're students of the markets, we're active in the markets, we're trading the markets. I think that we tend to focus and fixate perhaps too closely on the stock market or the Bitcoin market as opposed to the real economy. And I want to actually start with the real economy. I agree with the notion that I do not think a 50 or 25 basis point cut itself is going to have a meaningful amount for two reasons right off the bat. Number one, you've seen a significant move in the rates market even before the cut, right? You and I can't borrow at the overnight Fed funds rate, right? We will borrow at some, proxy for 10-year, the 20-year, and in many respects, when we're getting mortgages, it's significantly higher than those rates, but they have come down recently, and that's in response to forward expectations about a rate cutting cycle. So I don't think that's going to be a particular catalyst for consumer demand. If anything, I think there could be an argument to be made that as you move these rates down, people are going to want to put capital to work from money markets, because I think they're no longer going to get that 5%. They're going to want to say, I don't want to deal with that. But I don't think it's going to be a massive flow of new, some sort of new credit impulse into consumers that are going to drive the economy forward. I don't for one see that. That being said, there still is significant deficit spending, and that will be an ongoing, what I call pre-stimulus, and Lynn Alden calls fiscal dominance on a moving forward basis. That's going to continue to soften the blow. So all things being equal, I don't think it's going to be particularly meaningful. It's going to put some ease of pressure, most notably on the commercial real estate sector, which really wants rates to come down. But again, some of those rates have already come down. So let's talk about the stock market and the asset prices. So I think the markets themselves are extremely sensitive to real rates, right? And because inflation has been falling and now you're having rates come down, they've really been locked into that 2% real rate on some of the gauges. So what I expect to have happen is actually as you're cutting, that's going to hurt real rates in terms of a return, and that should be bullish assets. That's the thesis, right? Is it bullish assets? And I for one, think it is. I don't think that it's going to drive the economy forward, but the asset prices, just based on the cost of capital and the discounted rate, they should get a catalyst on a going forward basis and move higher. So my expectation, I think, is really that I think people have been consistently defensive throughout this entire last 2 years. And it's largely the product of the fact that in their minds, psychologically, they are trained with this idea. And I heard a little bit of this with the TXMC discussion, but I think we're trained that because the Fed is cutting rates, that necessarily is a sign of underlying weakness in the economy. And I strongly disagree with that. I do not believe you see any compelling justification for a recession here, and we can get into why that is. The principal reason why I think it's a mistake to look at this is because we had a shock. Okay, we had a 40-year height in shock from high CPI, high PCE, right? This inflation impulse that was a product of many factors, huge amounts of fiscal spending, cutting down the economy, the war in Ukraine, all these exogenous shocks that drove inflation up, right? Which caused a rapid response, which I really question whether the response actually did anything besides capsize a couple of banks, because I think that most of the actual inflation, the durable goods inflation, some of the factors, it would have resolved naturally over time as supply chain issues resolved, as wartime sourcing issues resolved. I think you would have had a natural disinflation take hold as you entered the reopening phase throughout the world. Okay. So look at the CPI basket, look at the PCE. The majority of what continues to hold up that, the bulk of what keeps those elevated, okay, that true inflation and other metrics discount is owner's equivalent rent. And what you have had is you've had a frozen real estate market where very few people are willing to give up their very low interest rate mortgages. And because of that, you have the sticky high owner's equivalent rent, which has kept all those things inflated. But the disinflation is real. I mean, you see it across multiple different segments. And if you take out the basket, which continues to be held up by owner's equivalent rent, by many gauges, we're under 2%. So, everybody, I think this is going to be totally unpopular with the audience, but I'm just going to tell the truth. I think that nobody said when the Fed came out and said inflation transitory, that meant 3, 6 months, or even a year. I think they weren't going to admit this, but they had a 1 to 2 year framework for transitory, and that was not politically viable, and people got very frustrated with the messaging and the narrative, so they had to pivot away from it. But the point remains, right? You saw a shock to the system, and now the cuts should correspond, I think, from just a baseline economic growth perspective to the disinflation you've already seen. This is why I always ask people, like, if you're making the argument about rate cuts, James, if you're saying we should or should not have rate cuts, first of all, tell me what you think the natural rate, okay, what the Fed calls R star. What is R star for right now? Do you think it's 4%? Is it 3%? I mean, CPI says it's just above 3, right? What do you think, James? I'll ask you. What do you think R star is right now in the natural rate of inflation given the high nominal growth? And that because of productivity growth in an economy, there's going to be an implicit rate of inflation that always comes due to that additional economic growth, that nominal growth that comes. So what is that? And then what the policymakers say is, okay, if the baseline natural rate is 3.5, as you put it, right, we're going to go above that or we're going to go below that to then determine what a policy rate should be, whether we want it to be restrictive, accommodative, or potentially neutral, right? And from the Fed standpoint, right, they are not cutting, and this is really key, okay, for this cutting cycle. They are not cutting in an attempt to be accommodative. Now, contrast that with 2019, right? 2019, they did a cut because the yield curve was inverted and they were seeing signs of slowing. And the idea was they wanted to cut below what they thought R star was in order to accommodate markets and drive some sort of impulse for growth in the economy. That's an accommodative. Same thing with the pandemic, right? The inflation rate at the early days of the pandemic in 2020 was cratering, right? Gasoline futures are negative, right? There's no inflation, there's disinflation. So they go to zero in an attempt to be accommodative for credit conditions and drive the economy forward. Here, what the cut is supposed to signify, and this is what I think people need to put in their models if they're trying to assess markets, we have a high rate. We think disinflation has taken hold. We think that, as the Fed says, the balance of risk between higher inflation and the labor market have come he says they've come into better balance, those two risks. What he means by that is that we're just as worried about the labor market as we are about consumer prices at this juncture. So what we're going to do is we're going to move closer, and this is his own words, closer to neutral. Still being elevated, right? If you cut 50 bips at effective Fed funds of 5.25, you're still at 4.75. And as you just said, that neutral rate's probably in the threes somewhere, give or take, right? So you're having a restrictive policy in place even with a cut. And that's what I talk about with real rates, okay? That's what's core. I think what the Bitcoin bulls and what the stock market bulls, what they really want is they don't want a neutral rate Fed funds. They want an accommodative Fed funds that propels growth. And that's when asset prices really rip.
And do you think so? So my kind of view is, I think what the Fed did by I'm amazed that J Powell got his 5.5%. That to me was a tremendous achievement that no one thought could happen. They got bullets back, right? People are often saying the Fed's out of bullets. Well, they really got a lot of bullets back into the chamber. Well, so in that regard,
yeah.
But I also think that there's like the higher low, right? Which TX and I talked about. There's this concept that they'll bring them down, but they're probably not going back down to zero, barring some, cataclysmic event.
No.
So as a result, we're going to have a higher structural interest rate environment moving forward, which I don't know whether the markets fully got around that process, but I totally understand the real thing, the real rates, where you're essentially squeezing that margin, and therefore for assets, it is, and particularly interest rate sensitive assets, they're going to perform off the back of these rate cuts.
Well, okay. So I try to keep my mind open, and I try to play devil's advocate with myself a lot. Like I argue against myself because I think it's helpful just for my trying to understand the world. But to get rates down significantly lower, what I think you need to do is you need to see inflation crashing. Now, what can cause inflation to crash? The bears out there who are going to tell you we're on the verge of a recession, and that's coming, and that's going to be a huge downturn, and you're going to see real estate prices collapse, and you're going to see stock market price collapse. In that environment, I would expect rates to be substantially below 2%. Mm-hmm. I would expect them to be, but you have to really get, I think, a catalyst that drives that. One of the things that I think is fascinating is that people are obsessed about these unemployment numbers, and the unemployment number, even right here, at 4.3%, which we can talk about whether that's a good data point or bad data point, or we've got flaws to it. 4.3% is extremely low by historical standards. 80+% of the time, you've had a higher unemployment rate for the last 50 years during even growth periods, right? Strong economic growth where we're running hot as an economy. You've had much higher than 4.3%. I think what's far more interesting is the claims data, which if you look at claims are still hovering in the 200,000s. Now, to put that in context, okay, which is always key, right? For most of 2010, most of 2011, most of 2013, long after the official recession had ended from the great financial crisis, you were running at $400,000 initial claims that were coming through again and again, month after month, repeated statistic. So even by historical standards, the claims data, which is hard data, somebody has to walk in, has to file an unemployment claim in the United States, that is still significantly low. And it's done so while absorbing millions of new workers into the workforce because of the relaxed immigration policies. So what is that to say? That's what to say is that if you're going to paint me some narrative about we're about to have some rapid rise in unemployment and a cascade of bankruptcies and failures and corporate restructuring and something systemic, tell me why the credit market isn't showing that. Tell me why spreads are still extremely tight. Explain to me in that dynamic why you have not seen, I think, the persistent rise of initial claims into the 300 or 400,000 range. And that, to me, I don't think there's a convincing argument. I don't really see anything there. And when you've made it this far, this is one of the things I just respectfully, I love TXMC. I love talking with him. But one of the things I struggle with some of the analysis is that even if you think that the rate cutting cycle is not going to be a massive bullish catalyst for the economy, which I agree with, I don't think it's going to be drive a huge impulse, James. Even if that's true, you can't convince me that cutting rates in this environment to bring them closer to neutral is going to be bearish. That's not bearish. If anything, it's neutral, and it's not going to be continuing to be a headwind for economic factors. I think there are certain industries where it will be mildly helpful, but it's not negative. And the fact that you're pulling your foot off the gas while at the same time keeping relatively high fiscal deficits tell me you've made it through the hardest part of the hiking cycle. The hardest part of the hiking cycle was when they had to rapidly increase rates in a very short period of time. The market was caught off balance. Volatility was skyrocketing. You had the MOVE index exploding, struggling to figure out how to react to this. You had a 4 sigma event in the bond market. You had basically a massive crash in the bond market. And yes, you had some casualties, but they're only the modest of casualties. I mean, you had a few banks. You had some, the gilt market issue, which was well documented in the UK. A couple of flare-ups like that. But you've made it through, and you're at the end. You're seeing the light at the end of the tunnel, and now people are saying, "Oh, this is ominous. This is going to be where we finally hit." And all the lag effects of the monetary policy. The lag effects of the monetary policy have never lasted this long. I mean, you want to talk about a statistic? Everybody points to the yield curve as having a very high record of predictive ability for recessions. James, do you know what the longest period where the yield curve has been inverted, the 10 and the 2 spread in history has been? You know what it is?
Is it this current environment?
It's this current environment. Or something? There is one without. There's no precedent. I actually tweeted about this. I'll give you the dates in a second. But there is no precedent for this long of a yield curve inversion. Every one of the prior ones, we had an inversion that lasted significantly shorter periods. The curve then uninverted, and then you were a few months from a recession. Okay, we're here now more than 700 days into a yield curve inversion at the 10 and the 2, and we still are not uninverted, number one. And every prior cycle, if you're going off every prior cycle, it's only after the uninversion that you sometime down the line actually get the recession because of that bull steepener where the short end yields are dropping very quickly and the long end yields are rising. So what is that? I mean, are people just going to ignore that fact that we have a historical period of inversion that has never in history been had a parallel? I mean, and this goes back to the broader thing. You as a data scientist, somebody who studies data, you understand that when you look at all these things, when you're looking at the SOM roll or you're looking at the yield curve or you're looking at any of these indicators, tell me in your mind, how big of a sample size does something have to be in a dynamic system for it to give you a true message? What would you say?
Oh, you need loads of points. It's like when people look at the cycle tops and they draw a line and say diminishing returns. Like you've got 3 data points there, guys. That's not really significant.
Okay, so, great. Completely agree with that answer. You should cut that clip up because it's key. But my point is, how many examples do we have of the yield curve inversion? You'll say, oh, it's 100% ratio of success in predicting recessions. You're talking about like 7 cases over 50 years.
And then I also hear people say like, oh, but which yield curve? Like, are we looking at the 3s and the 30s? Are we looking at the 1 year and the 10 year? Like people actually change which yield curve. Like, oh, but sometimes this one works and then sometimes this one's better. It's like one of them tends to work. It's like, I mean, if you take that kind of a scattergun approach, of course, something will work because you're kind of throwing a lot of darts.
Oh, absolutely. Absolutely. So here's the stats just for your audience because I wanted to make sure I had it right. So we are now inverted for over 755 days. The prior record was set in 1987. Okay, from 1987 to 1980, we were inverted for 620 days. So you're talking, 140 days more than the prior historical precedent. Before that time, okay, and this is the key. The longest yield curve inversion was 300 odd days, and before that, we had a yield curve inversion of 270. So you're taking some of those examples, right, and you're doubling the time of inversion, and you're just saying, oh, well, let's just ignore that. We're not going to pay attention to the fact that this time is really sending a very different message. And I just think from a data analytics point, you have to look. There could be factors that are clouding the data. I mean, one perfect example, like our labor data, okay? And this goes right back to what we've talked about. There are so many documented issues with the survey data, how they're actually putting those models together. Post-COVID, all the models blew up, and yep. The researchers and analytics people that are gathering the information, they're saying we're having really a lot of trouble gathering good, reliable data. So in my models, right, as I'm trying to assess this, and I try to be open to all possibilities, I have to question. You have to question if like you said, garbage in, garbage out. Are we getting an actual good, solid read on some of these indicators people are saying are clear signs of recession? And the other final point that I just wanted to make about this, because I'm sorry for talking, but it's just I feel
it's good.
I feel like this is something that's just completely ignored. Is that you hear a lot of commentators talk about this idea of a rolling recession, okay, where certain industries are, manufacturing, for example, is in significant recession. Well, the problem I have with that is that's never been the understanding from an economic standpoint of a recession. At any given point, there could be industries or segments of the economy or states or localities that are really struggling. The whole idea behind categorizing a recession, okay, was that we wanted a broad spread and diffusive economic slowing across all sectors, across all swaths of the consumer. I don't think you see anything remotely close to that. You see pockets of weakness who are struggling in a high inflation, high interest rate environment. You see other segments that are doing very well. That has never historically been a recession. That is just I think it just speaks to the haves and the have-nots, the strong and the weak in society. And while it's unfortunate, you obviously would like to have a broad, prosperous economy for everybody. We increasingly, as a society, are becoming more siloed and more stratosphered, right? Where you basically have, different pockets, and they're doing. It's a tale of two cities type thing, right? They're very, very differently situated.
Yeah, absolutely. And I think this K-shaped recovery is kind of one frame. I've also heard of like rolling recession, rolling crack up booms, where you have some industries that do really, really well. You go through some periods where like some commodities will do really well, some tech sectors will do really well. And it's just like, I guess it's the movement of liquidity around the system as it tries to work out what is like, I know they're dangerous words, but this time is actually different on a measurable framework, right? You look at a lot of things and this time is actually quite different. And actually, as we kind of move towards this, there's two topics I really wanted to touch your mind on. No. On this vein, the first one is this concept of the turtle theory that you've got running. And my term is chopsolidation, which is like helping people get their expectations in line, because this cycle is different. And I've got this like thesis, it's not fully formed yet, but this idea that everyone's looking for the classic 4-year cycle, the parabolic rally higher, and then the big nasty bear market. And my like underlying kind of gut feel is we're probably going to lose sight of where are we? Where did this cycle start? Where did it end? Are we in a bear market right now?
Or did it end? Did it end? That's the other thing.
Did it end? Exactly. I mean, so like, I think people are more likely to lose their bearings and say like, I'm considering writing a piece because I'm confident that we're probably going to break higher from here for Bitcoin. And then I'm probably going to release a piece and go, hey guys, we probably just had a bear market, right? Because to try and explore and say there's a lot of dynamics, but it doesn't look like it did in the past. And I think people are going to go looking for that same fight the last war. And I think this works in the macro world as well. They're going to fight the last war, look for the last recession, look for the last bear market. And it's just not going to look the same as previous cycles. I think it's a fascinating dynamic that's going to play out.
Yeah, I love that. I mean, so there's, I think I can find the quote. Peter Lynch, I think it's Peter Lynch. I was reading some of his works, and he talks about this, how, he used to have very smart, savvy analysts. And one of the things he always thought was funny is that one of them would come in with secret sauce in terms of an indicator and a path, okay, of here's what assets do, here's what stocks do, here's what the bond market does. And what he always used to do is he always used to put them, gather it in a book. And he used to say, okay, now that it's known and it becomes publicized, right, it no longer holds true. It no longer holds fruition, right? And I believe Bitcoin's in for this. Okay, there are so many people who say repeatedly, "This is what Bitcoin does. This is how the 4-year cycle works. This is," and I think that Bitcoin will continue to surprise both to the upside and to the downside with some of these things. I heard for years. Very prominent Bitcoiners who shall not be named told me, I don't think Bitcoin is ever going to break below the prior cycle high. It's like an indelible rule, like the 10 Commandments written into stone. Bitcoin can never break below. It did break below. Okay. And I don't say that to point out like a bearish, talking point. I say that says markets can be surprising. Markets don't perform the way you think they're going to. They're dynamic systems and they evolve and change with time as the market participants become better accustomed to what they quote unquote think will happen. I expect, in my mental model has, and this is where I view, Dr. Jeff, he talks about the bull crab. I kind of look at Bitcoin as a turtle because I think it wins the race, the tortoise, right? The tortoise and the hare. I think it wins the race, but I think it does in a very different way than we are accustomed to. We're accustomed to these huge sort of massive moves up. And I don't think you even saw that in not even this cycle, but in 2021. I don't think you saw a blow off parabolic top. You saw that kind of weird double top, which I don't think there was you correct me if I'm wrong, but I don't believe there's a ton of precedent for that in Bitcoin's price history, like that over multiple months where you had that. I would expect Bitcoin, as it matures as an asset class, to trade a lot closer to something like, a younger version of the S&P 500, that type of thing, where you have declines, you have corrections along the way. But I would not be surprised at all when folks are going into, say, 2026 and expecting some bear market, that you get a muted, 10, 20% correction, and then you head higher. Especially if you're getting continual institutional flows into the space because of the ETFs and other structural things. I think that's on nobody's framework. I mean, I keep hearing people, I heard Tone Vays, longtime Bitcoin commentator, the other day. He says, I expect the cycle top to be, at some point in, early to mid 2025. And I'm saying, okay, maybe, right? Anything can happen.
Based on what is my favorite line for that?
Based on what? I mean, do Bitcoin markets just die of old age? I think, in prior cycles, there was a very clear catalyst, okay, for why cycles ended. Price reached a point in which you freed up a tremendous amount of older coins that had made people incredibly wealthy. And then those coins came into the market and, supplied the additional coins that were needed to meet the surging demand. I don't see the structure, and I'd be interested in your take on this. I don't see that as the same structure anymore. I think that HODLer base, while they will always introduce supply at certain levels, it does not seem to be as pent up. And, I know some people are going to sell at 100K, but, the question is how much? How many people, after sitting in the 50s and 40s and 60s for a few years, are going to just dump all their coins for a 2x?
I love this question. And I've written a lot about this. I did a piece the other day called Why Isn't the Bitcoin Price Higher? And the rationale is, right, everyone looks and goes, but these ETFs, they're absorbing $100 million a day. They're absorbing, $50 million. Why isn't the price higher? It's like, because the hodlers, if you look at on-chain data, you can see realized profit, which are coins that were acquired low and they're being sold high. Now, not all of those coins are sold, but a decent chunk of them are. And as of right now, the amount of profit taking is also about $100 million a day. So we're actually seeing that. And if you look at the ETFs relative to just the classic Bitcoin spot market and hodlers selling, they're like 10 to 20% of the market size. So all these people focus on the ETFs and be like, but why aren't we higher? It's like, because the ETFs aren't the number one. They're like 10%, 20% is big. It's not dominant, right? The rest of the market is. I also explained
do you
to people,
include the futures, right? The futures, would you say that?
So futures are then 100 times bigger than spot.
I say this all the time, and people look at me like I'm crazy. Like, oh no, it's all spot buying. That's so important. The futures market, and guys, this is not different from a lot of other assets, as you know, James. I mean, the S&P 500 futures market is incredibly dominant, the SPUs, okay? The Treasury futures market has a huge amount of influence. The same is true of a lot of developed oil, gold. The gold futures market dwarfs the spot market frequently. So I don't know why people would think Bitcoin's different. I mean, that's what's confusing.
No, and every asset that reaches an appreciable size has a futures market. Yes. And without a futures market, the asset will not reach an appreciable size. These are part of the dynamics. And like at the end of the day, if you're still pulling coins into your own wallet, those coins cannot be rehypothecated and levered against and all this type of stuff. But then at the same time, you hear a lot of Bitcoiners, and we were at a meetup last night, and I think almost every one of the conversations at some point in time, the concept of would you ever sell or do you want to borrow against your Bitcoin? This conversation was pretty much where it all ended up. And like from my perspective, if you're a 2013 hodler, at some point, maybe at 70K, maybe at 100K, maybe at 200, you're getting close to your station. And that means that like you're going to sell 5, 10% to do something with it, right? Some people will do that. A lot of hodlers say, oh, you should never sell. It's like, I know you won't sell, but some other guy is. You know what I mean? Like that's just the objective fact. Someone is going to sell. There's going to be a whole pool of other people who are going to borrow against their Bitcoin when those products come to market. I think there's a huge market for that. But the nature of the beast is that you're right. Higher prices do unlock more supply. They unlock way more supply than people ideologically expect. But at the same time, right, we've seen huge amounts of sell side over the last 6 months during this Chopsolidation, and we barely got a 32% drawdown, which lasted 48 hours, right? Really, it's been like a 25% floor, which is quite remarkable given the amount of sell side, but just keeping things in perspective. People do sell, and it's a lot bigger than the ETFs.
Yeah, so I'll just tell you, I have a client. He told me this story, and I think it's illustrative for some of your viewers. This was a long time. I think he must have gotten 2012 or 2013, early 2013 Bitcoin, and he had a significant holding. Okay, and he told me that he ideologically was very much never sell. I'm never going to sell. I'm going to hold these coins to my grave. I think Bitcoin is the greatest thing ever. And he still believes that, by the way. His views haven't changed on it. But he told me a story in December of 2017. He was staring at his Coinbase. At the time, he had a significant holding on Coinbase in addition to cold storage. And he was looking at, Bitcoin, $18,000, $17,000, and the amount of money that it had came from very modest means. It was life-changing, right? And he said, I knew, Joe, that despite all my ideological views of Bitcoin, despite everything I believed in it for the future, he's like, I couldn't stop staring at my phone because of the fact that this was so much money. And from where I came from, I had to part way with some of his stack. And he kept 75% of the Bitcoin. He's very well-off individual. But my point is, like, those sorts of factors come into play. I mean, those emotional aspects of it, when you see those numbers tack up, it's very difficult. People can easily say something when they don't have it immediately in front of them as an option, right? When they could take that sale, right? And to me, as somebody who's held Bitcoin for years, I mean, I haven't sold in many years now. I view it as like, okay, I don't know where this asset goes. I really don't. And there will always be my core holding, but there are levels where, if I'm being honest with myself, if it changed my entire family's future outlook, I would have to do my diligence and think about, reducing some of the exposure. I just, if I'm being honest, that's just the way it is. But what that level is different for every single person and individual.
And by the way, this is exactly why things like MVRV work so consistently, because, and I use this line, it's like, every hodler, I'm going to ratchet up your profit to 100%, 200, 400, 500, 1,000. I'm just going to keep turning up the dial. And at some point, you're going to sell. And on average, we typically get to that dial gets to about 300 to 400% on average. And that's the point when there's enough sell side that the demand can't keep up. And ultimately, price is a game of supply and demand. And the higher that the price goes, the more supply will come back to market. And it's also why I just encourage people never spend your brain and your time and your gray matter worrying about exchange balances and exchange flows and all that kind of stuff. Because at the end of the day, there's coins flowing in and out all day. Some are collateralizing a loan, some are selling, some are buying, some are moving between exchanges. It's just such a noisy set of data. But ultimately, people focus on it because it seems like, oh, they're buying and they're selling and the ETFs bought this much. It's like, yeah, but who sold those coins, right? These are dynamic systems. And that's why I think on-chain data is super useful, because you can overlay the human psychology. Everyone has a price. As much as you tell yourself you don't, you keep ratcheting up that price. At some point, you want to go and change your family's life. You want to buy a house. You want to pay off your debt. You want to do something to improve your life with your savings. And, this is just the nature of markets. And I think when you separate that ideological component, and you look at it objectively in the data, like, it may not be my sale price, but there's a lot of people whose it is, right? And I have
Yeah.
to analyze it based on that being a constant.
So I have two quick questions for you. I know we may be running short on time, but I believe your audience would really want to hear these if you can explain this.
Yeah,
So,
let's go.
okay. So the question I have for you is that as you know, I follow the TradFi markets very closely, as we talked about here. And I see time and time again in moments of high volatility, correlations go to one, Bitcoin sells off, and look at the yen carry trade issue. Bitcoin was selling off under $50,000 briefly before getting rapidly bid up. My question is this: for the TradFi market, okay, the active traders, the active managers, do you believe that they are principally trading off volatility in traditional marketplace, or do they have sort of more particularized volatility indicators that are driving their analysis in Bitcoin? So let me try to phrase this a little bit differently, because I do know there are desks out there that are trading Bitcoin, funds that are trading Bitcoin, and when they're trading it very similar and based on similar indicators to traditional finance, to the SPOOS contracts they're trading, to the NQ contracts. What segment of the market is that? I guess I call that just sort of the TradFi market that has exposure to Bitcoin. Is there any way to calculate that or sort of read into what that is? The more active management that is putting on what I've heard, traders I represent, they call, they say Bitcoin's like a levered NASDAQ, right? Like what would you, if you had to take a guess, what would you say that is? That portion.
So that's a really good question. I think the number one data point supporting this is the growth of CME as an exchange. So if you wind back the clock 2 years, right, pre-FTX, CME was like 10% of open interest. It's now, and Binance was the lion's share of it. CME is now the gorilla in the room. It's 35 odd percent market share. Binance is now like 20, 22, something like that. So CME has actually exploded and increased above the scale of Binance. And Binance really is like that's the everywhere else in the world, that's the preferred exchange for,
Right.
for futures. Now, the other thing that I overlaid is I think it would have been around June, May period. There was a whole bunch of people looking at these massive ETF inflows. And this is when people are talking about, not the yen carry trade, but the cash and carry trade. And I basically wrote this report and I looked at the ETF inflows and I overlaid the change in CME open interest. And it was a very, very strong correlation. So you're seeing these people who are buying the spot ETF and selling the futures, right? You get more open interest and people are buying the ETF. And so I think that trade is actually quite significant. I mean, the basis there has been something on the order of like 10%, which is 2 times the risk-free rate. So once you put some leverage on that, suddenly people are actually making some serious money. And the other component to that, and this is why people say, oh, the futures are suppressing the price. It's like, well, no, there's a 10% premium in futures. That's because people are buying and going long.
Yeah.
So I don't really know the breakdown of firms that are kind of actively managing, but I see the sheer size of it overtaking Binance. That to me is a very, very meaningful data point. Another data point is, I've spent a lot of time in on-chain data and trying to, talk to different clients and help them understand this data. It is a absolutely mammoth challenge to convince people. And that's why I actually, at the end of the day, it's why I just decided to write the newsletter, because I can just do it on my own time. But trying to convince quants that the blockchain data itself of the asset that you're trading has a whole lot of signal baked into there. I can't begin to tell you how hard that was. Quants don't seem to understand this. So we are so far away from them having like bespoke models. There'll be like prop shops and stuff to do it. But on a big scale, I would say they're plugging in volatility, price, and correlations to the rest of the market.
Yes.
And that would be probably the primary way they trade this stuff for now.
Okay. And so they're plugging those data points in. So it's really sort of I guess what I'm trying to figure out is volatility picks up in the S&P 500. And to what extent does that have a relationship to the volatility pickup in Bitcoin? And I look at like the 5-minute charts, and it's kind of stunning, sometimes, especially when volatility is picking up. They're literally moving tick for tick, which is fascinating.
I've actually got a chart that shows Bitcoin's volatility and the Mag 7, and it's the same wave, right? They go through different periods. Sometimes Tesla's more correlated back in 2021. Sometimes Nvidia's more correlated, but like the volatility of these things is on the same magnitude and moves together.
Okay, so what is driving? That's being principally driving by the like you said, those algos running the exact same models.
I think so.
Okay.
risk models, and that's why you see with the yen carry trade, right? They just sell everything, and Bitcoin's the only thing that's live on a Sunday.
But they're putting that on through the CME futures, correct?
Yes, that's a major venue
So
for it
what
for
is the
sure.
trend? And this is going to be my second. I see the same data. I see the same explosion in the CME. That was my own, sort of deep dive into this. What is the transmission mechanism here, given how spot sales occur and what we know based on, the Binance data and the Coinbase data? What is the transmission mechanism from the CME futures contracts? In other words, who's facilitating that? Because somebody has to hedge with the spot, right? So how
Yes.
you explain that relationship in your mind, if you know?
That's a good question. So I think if I look at, let's just like narrow down the scope and say we've got, let's say the carry trade.
Mm-hmm.
Someone wants to go long the ETF because it's the most easy vehicle for them to do it, and
Yep.
they short the CME futures.
Yes.
Now, there's periods of time now where this for the trader, this is neutral because they're long spot, short future. So for them, they don't care where the price goes, up, down, left, right. It doesn't matter because they're going to be break even. They're just capturing that premium. However, the ETFs the ETFs are about 50% as big as the spot market, and then the spot market is 100 times smaller than futures. So now let's think about what happens when that trade has to unwind. Let's say the trader is finished with this, they want to get their capital back. They have to sell the ETF and buy back the future. Now, if you've got a market that's 100 times bigger, you can buy and sell whatever size you want. It'll just get absorbed into that volume. In the ETF, because you're selling it, and if there's a low volume period, which we have actually seen for several months now, it's been relatively low volume. You're now selling the spot into a much more illiquid book.
Mm-hmm.
So you can actually get this downwards price on the market because as for them, they don't care. They're perfectly hedged, but the market has to actually absorb that ETF sale. So you can get bid on their way up, you can get sell on the way down. So for the market, it's not necessarily neutral, but for the trader, the position actually is.
That's perfect. Thank you so much. That's awesome.
Yes, it's all about that liquidity component, right? How much can the book actually handle? ETFs can handle less than the futures market.
Fantastic. So any other
Nice.
questions you have for me?
I do. I have one more question.
Sure.
I see this all the time on, Bitcoin trades down 5% and all of TradFi light up and say, store of value my ass, right?
Right.
I love this concept because it's like, let's look in on the 1 minute chart and say, look, it's not a store of value. I also see that you've got a lot of tweets where it's like, Bitcoin versus NVIDIA, Bitcoin versus QQQ, gold versus QQQ, all these things. And again, what is your denominator? How are you comparing these things, right? Is it inflation adjusted, blah, blah, blah. When we talk about store of value, like for me as an individual, when I look at the market, Bitcoin has been a tremendous store of value for me. But I've been in the space since 2017, right? 2018 is really where I kind of paid my tuition. So that whole process for me, that's a time game, right? It really is a time in the market and a conviction component, right? Continuing to buy even though things are down. So for me, it's been a great store of value. For gold, I can also see it's been a store of value. If you look at gold in the USD, right, which most people do, it's gone through its troughs and everything else. I would recommend people plot gold in the Australian dollar, which is my currency. It's just a straight line up. It looks like the S&P 500 with a bit more volatility. So gold is also a store of value for my currency. So what's your kind of framework here? Because something that I certainly am challenged with, and this is like a kind of helping the audience understand this stuff. For me, I understand Bitcoin. I wish I had my on-chain data for gold and everything else because I feel blind without it because it's just got so much clarity of what's going on. Picking individual stocks, picking stocks like stock indices, all this type of stuff. People obviously store their value on what makes sense to them and then performs. How do you think about that concept of what is a store of value and on what time frame is it actually reasonable for TradFi to be like, oh, look, it's down. It's like, yeah, but so is everything else at some point in its life.
Yeah. So I am a proponent of Brent Johnson's dollar milkshake theory. I assume you're familiar with that, the rough basics of that, which I think is fascinating because I think that from the perspective of asset allocation, you should be overweight assets that principally are proxies for the dollar. And I view particularly the S&P 500 and also the NASDAQ as sort of proxies, as really foreign exchange hedges for the dollar. And I'll explain why. If you look at the globe, right, and you look at the debt problem, and you look at every country having to effectively manage their debts through quote unquote printing and injecting liquidity and buying those assets, right, you have to realize, why are they doing that? They're doing that to service dollar-based denominated debts. Okay. So dollar denominated debts outside the United States actually dwarf the debt obligations in the United States. And I repeat this all the time because people just are baffled by this. But put a different way, the entire world is short dollars. And their funding mechanism for shorting dollars is, to your point, debasing their native currency to then pay their dollar-based denominations back, thereby pushing liquidity into the U.S. capital markets. This is why most European markets, I think, equity markets have struggled, and I think because they don't have the foreign exchange protection that the S&P 500 has. I mentioned in a room the other day, and I think it's really important for folks to remember, is that the first asset you need to buy the S&P 500, if you have yen or euros, you need to buy dollars. You need to get your dollar exposure, then you can get access to the S&P. If you want to buy American real estate, you first need to get your dollar exposure from your native currency and then buy the US real estate. Where Bitcoin fits into this is I think people have built into their heads that gold, if that's rising, that's going to be negative for equities. I think people have built into their heads that the dollar getting stronger, obviously it's pulled back a little bit here, but getting stronger over the last 10 years, that is somehow negative for U.S. assets. I strongly disagree with that. Brent, and he outlines this in a very comprehensive way if you listen to some of his podcasts, his expectation is over the intermediate to long term, you see the U.S. dollar, you see gold, you see U.S. equities, and I think I add on Bitcoin. I think they will all rise together. Now, when does some of the assets begin to depart from one another? I think the benefit that you have in the U.S. equity market, to answer your store of value question, is that it is not only the retirement savings of most of the United States, they're funneling their money into U.S. equities, but it has become the de facto savings mechanism for the world. I think it's sucking in a ton of capital. So to me, your baseline, okay, it's no longer, I mean, yes, the risk-free rate is by the treasury market, but the baseline store of value for the world is the S&P 500, and then for the more risk, those with a higher risk appetite, it is the NASDAQ 100. Okay, those are so dominant in those companies, and those are the biggest proxy really for a functioning treasury market that we have. I mean, if the treasury market were to somehow become an unsuitable investment, to have the ability to absorb the flows internationally, you're really looking at mega cap tech to pull in those flows. So when I look at Bitcoin, I look at, okay, Bitcoin, which I think is, my personal belief, I think it's still ridiculously cheap relative to what I think its potential is going to be. I look at the S&P 500 because it tells me that still flows are still mindlessly circling into those assets for the time being, and Bitcoin has yet to really appreciate in many respects against those. I mean, I look at the NASDAQ 100 versus Bitcoin. I don't think we've made a new high in those terms since 2021. People see me post that and they think, oh, that's a negative. No. The reason I post that is I still think that even with the flows, even with Sailor, even with the ETFs, you still have the majority of the world short Bitcoin. And until I see a massive breakout in that will give me pause to say, okay, I think that now we're getting closer to the point where I think you're getting the levels that maybe in the short run are deserving of a pullback. The strongest bull markets that I have seen have been ones where the S&P let's take NVIDIA, for example, where NVIDIA relative to Bitcoin, it called most of those tops, right? When you pull up that chart, you can see where like there's a massive pull, and I think one was in November of 2021, and one was in 2017, the December one. Those are proxies for me for real debasement, okay? Because that's just a general TradFi flow for risk against Bitcoin, which is the purest form of debasement protection. So I look at those to give a more meaningful picture than the USD price, because as you know, the USD price, it doesn't give, I don't want USD. My goal is goods and services, right? And goods and services, I think, are better reflected in certain, number one, not necessarily in consumer prices, but in the overall level of debasement. You have to measure something. So I use stocks because I think that is the preferred store of value, I think, of the world.
No, I think that makes perfect sense. And I've got a chart on my website that's Aussie house prices priced in gold.
Yeah.
Because ultimately that's the thing I'm saving for. That's the thing that's my inflation rate is the house price. Since 2020, they're up 40% here in Australia, but they're down 75% in Bitcoin terms. So, that's the reference point.
But most
I
real
also like
estate,
this
but even real estate that's on the tear, right? Real
Yes.
estate's gains, and I don't know what the property values look like in Australia, but I mean, I throw up some of those charts versus the S&P 500, how debased they are versus the S&P 500. That's meaningful, right? Because housing is
Yes.
government, at least in the United States, it's largely government subsidized. There's tax benefits for it. We've made it a national priority that everybody get a
The
house.
same over here. In fact, I would say Australia is even further down that path, probably competing with Canada and NZ as the only other places that are that. Like for us, the S&P 500 is the Australian housing market.
Right. So if that's the S&P 500 for you, and then you take that value, which is the housing market in Australia, relative to what the S&P has done for the savings of choice for retirements and for pensions and everything else, I think it just shows you the other degree of debasement. So to
Absolutely.
me, that's like that should be your underlying denominator. You should go against the strongest, not strongest. The right word is the most widely held savings store of value. That should be
Yes.
the most widely, yes, you're going to find idiosyncratic stocks here that have, Monster Energy's up 1,000,000% or whatever. I don't really care about that because they're not as widely held. Everybody who has S&P 500 has a significant share of NVIDIA right now. Every single person. Okay. It is a pure play on that. And there's obviously a narrative there with the AI story too. But to me, I think I like to look at Bitcoin in the S&P 500 terms. I think that's like a very pure signal.
No, I think that's really it's a relative world, right? Money has to go somewhere. It's all about the denominator. Are you looking at the currency because that's getting debased, and then you say which currency? Are you looking in terms of I agree. I think that the default store of value makes perfect sense. And the last thing that I really pulled out of that, at the end of the day, why do people put their capital into the S&P and the Nasdaq? Because we know the world's going to go through whatever it's going to go through over the next decade. It's going to be all sorts of turmoil and all the rest of it. The S&P 500 will still be trading in 10 years' time, right? It's one of those things that will still exist in 10 years' time.
Well,
and ultimately, for me, the story of value is I know gold's going to be around in 10 years' time. I know Bitcoin's going to be around in 10 years' time. It's that confidence that I know these assets are going to be there at the end of whatever comes next.
Yeah, and this just one final thing on this. I hear this all the time that I can't invest in the S&P 500 because it's overweight mega cap tech. And what frustrates the hell out of me, James, with that discussion is, as you know, and for any listener that doesn't know, the S&P 500 is not a static instrument. It is a dynamic one. What do I mean by that? I mean that it is built to change with time. Let's say mega cap tech takes it on the teeth for the next 10 years and has very lackluster performance. And let's say energy stocks and durables and industrial staples, whatever, they all gain in relative market share. Well, then the composition of the S&P 500 on a market cap basis will change to reflect that. If energy becomes dominant and that's the future growth, the market cap of the S&P 500 that is devoted to energy, which is like sub 10% right now, that will grow and that will be where the money flows, right? The instrument itself will adapt to where flows are going on a market cap adjusted basis. And it has done this historically. And that's the whole idea behind indexing. That's why you want to own equity. To me, like that is capital going in a location that I think it is being best treated, and it's adaptive. To me, that sends a very powerful message, and I think that people miss the fact that the current composition of the S&P 500 is reflective of the companies that have had extraordinary profitability over the last 10 years. Tech is at the center of our lives, and if that changes, the index will change.
Yeah, no, I think it's a fascinating point. And like at the end of the day, this is why getting down and actually thinking about the nuance of what am I looking at, right? Whether it's SAM rule data, whether it's indices, whatever it is, understanding what you're actually looking at is where so much alpha is. And this is the thing, it takes time for the market to work these things out. But it's that voting machine versus weighing machine. In the short term, anything can happen. In the longer term, when you actually really bake down the reality of what's going on, that's ultimately where many investors essentially make their fortunes, is by understanding the long-term trajectory, how people really think, what's the psychology and the mechanics of the plumbing and all this. I mean, this is why students of markets is the exact right term, because it's just an endless puzzle trying to solve. So, mate, that's been absolutely fantastic.
Yeah.
Really enjoyed this, and I've certainly learned a lot.
Thank you so much. I mean, like I said, I think we're entering a period here where by the end of the year, okay, if you do not see a significant rise in unemployment, and I'll just leave you with this, then I think the Fed has achieved what people have said is unachievable, which is the soft landing. I mean, you have to look at literally even some of the diehard bears are going to capitulate by the end of this year, because if you stick around 4.5, 4.4%, I think you're going to be on the upswing of a more positive growth cycle, given the rate dynamics. So we'll see. I mean, I'd be happy to come back anytime. I love this conversation, and thanks for having me on.
No, mate, it's been a real pleasure. Thanks for coming on.
Take care,
Cheers.
James.